Okay, very good morning. Assalamualaikum warahmatullahi wabarakatuh for all my students. This chapter 9 will be the last chapter for this subject Islamic finance, which we have done for 10 weeks on the subject. The rest will be your revision and for preparing for your assignment. So I don't want to take too much of your time so that you can pass up a better assignment when you need when the time's due time lah, yeah. So on this chapter we are uh, lecturing on the financial and operational risk of Islamic financial institution. Well, every business there's a risk. There's no business without risk. The saying said the bigger the risk, the better the return. So people take small risk, you make small profit. People take bigger risk, you make big profit, but also possible big loss. So in business, there are two sides of the coin. Either you make it or you lose. There's no guarantee in business that you are to make more profit all the time. Yeah. If business is profiting all the time, I think everybody in this world will do business. Nobody want to work with somebody else because they're sure to make profit, right? Why you want to do business? Why you want to work with people? If you can do business and can make profit, everybody will do business. Must understand very well. The business have a two sides of the coin. Either you make it or you lose it. Some people ask during my ceramah here and there, or when they call me, they ask me how to do business to make sure they guarantee the profit. That means what they are asking, how if they want to do business, they are sure they want to making money. Well, I said, I have no magic lamp that I can tell you how you should do a business and make profit. Because that is the nature of the business itself, that in any business, there's a risk. Either you make money or you lose money. You ask me, for 45 years in business, I said the risk is 50-50. So there's no guarantee more than 51 or 60% sure you make profit, 40% you may lose. No. For me, as to my own 45 years experience, the business is 50-50. That means either you make money or you don't make money. No guarantee of making money. So today we are talking about the risk this takaful operator taking for running the business as a takaful operator, yeah, or insurance operator. Okay, for today, learning objective, the final chapter, maybe a little bit difficult to understand. It doesn't matter. You cannot learn all the easy thing because you need to learn as you now the last topic. Sure, the subject a little bit difficult to understand, but it's alright because these are basic thing you need to learn, and in future easy for you to understand. Yeah. Overall, the Islamic financial institution and the risk they are taking. We are talking only just before this, their product, all the kinds of things that they have. So what is their risk? So we need to teach you business risk of this takaful operator. So there's four learning objective there. Okay, introduction. The risk exposure of all financial institutions relates to the protection of this depositor interest. Okay, what is this? This is very simple. Yeah. In this situation, we're talking about insurance. If you're talking about bank, then the same story. They will get the people money, keep the money with them. They call it depositor. So their risk is with this deposit that they're taking. Here in insurance, the risk is that the premium that you paid to the insurance company for them to cover or indemnify you of any losses, and the expected return investment on the money that you paid them the premium. Yeah. So because when they collect the premium, when you buy the insurance, so they have to make sure that they have to invest that money to make return, to make profits lah. When they make profits, then they have to distribute back to the policy holder. The other risk is that if there's a claim, as I told you last class, let's say we take example of the Malaysia Airline crash. So suddenly there'll be big claim by the people who buy the insurance. That is the risk exposure that we are talking about here. Second, in addition, we will explain and compare the risk faced by conventional versus takaful. Third one, finally, we will highlight the pertinent issues regarding risk management within the Islamic financial institution. So, not very difficult, but a little bit heavy subject, stuff that you need to listen and understand properly. You lose concentration, you may lose the whole what I'm going to lecture today. Yeah. Okay, the development of IFI, Islamic Financial Institution, as well as the proliferation of Islamic financial product and prevalence of Islamic financial activities has accounted for a significant percentage of funds mobilized through the IFS. Previously lecture we said during the oil boom in the Middle East, there's so much surplus of fund. So because of that, they mobilize the fund to help other countries, to help the poorer country. So we have these Islamic financial banks and all set up. Yeah? The distinctive nature of Islamic financial activities, as well as the unique product features and financial intermediation mechanism, require a review of risk exposure of financial institutions as well as their activities. Well, before, as I said, 1,400 years ago, when they start this Islamic finance, it's more a localized matter. During the small, only within that small community of people who doing the business, trading, and all kind of business activities. But now, we are talking global Islamic financial activities. The structure is totally different now. The structure is totally different now. So because of that, there must be proper set guideline, regulation, moderators to check and balance all these big financial commitment activities in other, not only localized in their own country, but also overseas and throughout the world. So this phenomenon is highlighted in several papers presented by international agencies such as International Monetary Fund and the World Bank. On top of all this, we have this IMF, International Monetary Fund, and World Bank, which is based in United Nations in New York. So they set policies to all the financial institutions, whether they are conventional or whether they are Islamic. So there's a set of rules that everybody have to follow and agree and to follow, so that the activities can properly run and there's a check and balance lah between the risk of all this investment. So what is risk management framework for IFS? What is actually we are talking about this risk management? Islamic Financial Board, the role of IFSB is to promulgate, to spread international standard of guideline that enable the financial authorities to ensure the soundness and the stability of Islamic financial services. So there's a board that's set up by all these financial system, financial owner, all the banks and all those investors. They call it IFS. So there's a board. What is a board? They comprise of expert people in this field, committee, people, there are people in this committee. So these are the people who are specialized in Islamic finance, who are already studied deep in the Islamic financial services. So these people sit in the board will regulate and promulgate all the terms and conditions that each international financial institution set up and operational their business. Yeah, one of them is to make sure the risk is minimized. If not, there'll be problem for the IFS. Give small example lah. If there's no ruling, one bank can give maybe $100 million loan to one person, whereas the Perak capital is only 500 million. You give to 5 people, money finish already. So they have a regulation. So every bank can maybe give only maximum to 5 million loan to each party, or kind of that. But if the bank paid up is big, 1 billion, okay, they allowed the bank to give to each company or each person for maximum of 10 million. So these are the regulation they have under this IFS, International Islamic Financial Service Board. This is the guideline that is written by the World Bank and on all these activities. So one of these is this is for the risk management framework, so that the bank, if they have a 500 million Perak capital, will not give to 2 or 3 people to borrow the money. And if these 2 or 3 people fail, as I said, the business is always two sides of the coin, then the whole 500 million of the bank wipe out. That's one of the reasons why they have to control the maximum each customer can borrow. Secondly, if only they can give big loan to this a few people, what about the small business, small medium enterprise? How they're going to borrow the money if only the bank focus on big loan to the big people? So these are here. The regulator will give them the guideline how the bank should manage the funds, so that they have a minimum risk on managing their fund. What is the risk just now? If they got a bank had a 500 million capital, they give to 2 person. One is 250 million, the other one 250 million. Okay, fine, they can give. But if these 2 person fail, or if 1 person fail, the business, the bank is going to lose 250 million. How is it going to survive to get back the money, 250 million? And then this kind of business you give to 2 people, what about the small people, small SME, small enterprise, which also need small loan, so they cannot borrow. So this is how the regulator have the things so that the risk is minimized. Okay, so liquidity risk arises from situation which a party interested in trading an asset cannot do because nobody in the market wants to trade the asset. So liquidity risk is same like I said before. There's no money. People don't have money. Like today, very good example lah. This COVID problem now, not only in Malaysia, everywhere in the world, they're short of liquidity. There's not much money to circulate because everybody don't make money. Everybody no produce anything. So you don't produce anything, everybody sleep at home. So nothing can sell, so you don't get any money. So you don't get any money, you cannot spend. That money you can't spend, we call it liquidity risk. Now, nobody want to spend money because they got limited money. Either they have already been sacked from the job or they already closed their business. So liquidity risk also the takaful operator need to calculate, before they invest your money premium that you give to them. But nobody can predict anyway. Like today, who can predict this COVID situation came and now become very worse? So sometimes even they predict, like for this happening now, nobody can predict this. We call it coronavirus risk lah. Maybe you have to write the coronavirus risk that never think what is happening now. Even we have not gone to the worst, there's still maybe you have to go down further if they not recover, because now we're talking about new variant, Delta variant, that variant coming up. So some sort like I'm seeing, not immediately you can solve this COVID matter. This is where we call it liquidity risk. Less people got money to spend, no liquid, the market not liquid. So this is what liquidity risk. It's not that we're talking liquid water, drink water. No, we're talking about money. Yeah, okay. Okay, then we have also this market risk, what the bank have to calculate. The risk that value investment will decrease due to movement of market factor. The 5 standard market risk factor, namely equity risk. These are all I already explained, but this is talking more like you buying shares lah. You're buying shares, tenaga now at 10 ringgit, suddenly now drop at 7 ringgit. So that is the risk lah. When the risk that happen, it involves all the factors, which is the equity risk, rate of return risk, currency risk, liquidity risk, all in will be under one thing. One counter drops 3 ringgit per share. These are the risks the bank have to calculate. Yeah. Credit risk transaction. Credit risk is a potential that counterparty fails to meet its obligation according to the agreed term. This term vary with form of equity, sale of lease, type contract, ABDUL for financing investment made by the IFI. Just to give an example, the bank or IFI borrow or give loan to people to, in my case now, I have a timber business, sawmill. So now with the AMCO movement in my state, in our state, Negeri Sembilan, all the factory had to close down because we cannot operate because of the government ruling that under AMCO, the factory cannot operate. So with this cannot operate, I may fail now to deliver the order that people order from me to buy the timber. So if I fail to deliver the timber, then I fail back to pay back the money to the IFS, which lend me to do the business of the sawmilling. So this is what they call it credit risk. Although this situation is extraordinary, everybody can understand lah. But we're talking is a non-COVID area lah. We put COVID not around. Your business stop for what reason? Maybe the big floods. I cannot get timber to cut my sawmill, so I cannot deliver my product to the buyer. Yeah? So these are some examples. So this we call it credit risk. Then operational risk institution. Operational risk is of loss resulting from inadequate or failed internal process, people and system from external event. This one, as I say, is a management risk lah. Operational mean management risk. Pengurusan. If some, like in my college, I run the college, I manage myself. But other people, big institution, they ask people, employ people to run the business for them. This is very dangerous lah. If the people, you appoint the CEO or somebody else to run a business, if they did not run it properly through the internal process, no strong internal process and system, it may lose the business for you. This is very important. That's why a lot of people, like in myself, I only do business which I can operate. Otherwise, I won't do business because we cannot depend on people. If they fail, you are going to fail, not them. They are just salary owner. They just pack their bag and go. But whatever shit they left behind, that you have to take care. So this is the operational risk. The bank also have to look. Sometimes the bank will see whether the owner himself is running the bank, running the business, or who is running the business before they want to give the loan, because they have to look into the management risk or the operational risk. If these people who run the business not competent enough or cannot keep to the projection of the business. Currency risk event. Currency risk is a form of risk that arises from the change in price in one currency another. I give that simple explanation just now. If 15 years ago, $1 equivalent to 2.5 ringgit. Today, $1 4.5 ringgit. So you just imagine, depreciate our currency. There's no business within that. Just the money depreciate. So if today the American want to buy one big building in Malaysia, 10 years ago, he has to pay 25 million ringgit. 25 million US dollar. Today, because the currency is 50% decrease, so they need only 12 million US dollar to buy the building. So they get cheap thing. And now, you want to go to America, last time you can buy cheap because our money value is $2.50. Now you go to America for holiday, you have to pay $4.50 to $1 US. So these are the risk. There's nothing happening in between, just the money only depreciate. Yeah. What I'm trying to say, there's no commodity, there's no trading, nothing. It's just the depreciation of the money. Very simple. If last time in Singapore, they are part of Malaysia, one Singapore ringgit, Singapore dollar equivalent to one Malaysian ringgit. Today, one Singapore dollar equivalent to 3 Malaysian ringgit. It's just depreciation only within these two countries. It's only across the border only. You don't talk about America. Yeah? These are the business people like these banks, everything have to calculate the risk in future. World ringgit will go further or down. Let's say today US dollar, $1 450 ringgit, $4.50. In future, is it going to be one US dollar 6 ringgit or not? These are the risks the bank have to calculate. If we go down further, what is going to happen? Well, if we go up, what is going to happen? These are again risk, what we call it currency risk. Just the money depreciation or appreciate. Yeah. Then commodity risk, commodity to uncertainty, future market values and the size of the future income caused by fluctuation in price of Sharia approved commodities. Here we're talking, let's say, commodities about oil. Yeah. Very good example is oil. At one time, the oil about 90 US dollar per barrel. I hope you understand this is barrel, satu tong lah, barrel. But now it's dropped to about currently I think about 40 US dollar per barrel. Yeah, this risk of the oil we call it commodity risk lah because of the oil. Just now currency risk, just the money only. So you can see the different risk we're talking. Yeah. Then equity risk event, equity risk is the risk that one investment in Sharia approved equities will depreciate because of stock market dynamic cause one to lose money. Same thing lah. If you're talking about they invest in the stock market, or if not in the stock market, so they invest into a company. So if the company lose money, so they lose on the equity on the company. Or if they invest in the share stock market, if the share stock market shares goes down, they lose also on the equity they have in the stock market. Well, if they goes up, they make the money. But here we are talking the risk, chances of risk. The takaful operator will be looking into because they're going to invest the money, the premium that you paid them, so that they can give the return back to you. Okay, then we have this call it liquidity risk transaction. Liquidity risk arise from institution which earlier cannot trade an asset with underlying approved Sharia contract or to obtain liquidity because of lack of buyer. So this liquidity now, not money, but of the product. Suddenly nobody want to buy oil because of there's not much activity during this COVID time. That's why the price of oil from 90 US dollar per barrel now become 40 US dollar per barrel. Because why? There's no liquidity of people want to buy oil. So when the supply exceed the demand, if you learn last time from Informsing on economic or from the school, so the price goes down. When the demand is better than the supply, then the price goes up. This is economic theory lah. Here also you're taking the microeconomic, you learn that kind of thing in case you don't learn in the school lah. Rate of return of risk. Rate of return of risk relate to the market factors affecting rate of return on asset. In comparison with rate of investment account holders. Is derived from profit sharing agreement between the shareholders and investment accounting. Okay, simple thing only. What they're going to split here. Earlier we talked that you pay the premium to buy the insurance. So first, they covered your indemnity lah, in case your accident or kind of thing. Second, if there's no indemnity they have to pay out, the insurance now will invest the money, buy into all the stock market, commodity, all kind of thing. So here we are talking about the rate of return investment of the account holder. How much you will get at the end of the day if there's no big catastrophe that the insurance have to pay out. So maybe, as I said just now, you're talking about rate of return. Yeah. So for example, in a conventional bank, you invest, the bank say invest in the factory, we are talking about rate of return of 10%. That means if you have 1,000 ringgit investment, expect at the end of the year you make 100 ringgit lah. So but if there's a so lot of things happening, they make 100 ringgit, the insurance company, but they have to pay compensation here and there. After minus, maybe you get only 10 ringgit. So this is the rate of the return risk lah. Is how they calculate. It's more technical, this one, but just simple as that. How much percentage can you make from the money you invest? Let's say you buy insurance 2,000 ringgit. So at the end of the day, if rate of return 10%, you got 200 ringgit lah. But if there's so much risk, you can get maybe 6%. Like you see now, the tabung haji said declared 4%. Or very easy, simple, EPF, the Employers Provident Fund. This year not making much of profit. The return dropped from normally 6% to 4%. That's how they work it lah. Yeah? Displaced commercial risk. Displaced commercial risk relates to market factors affecting rate of return of asset in comparison rate of return of shareholders. They are the return for shareholders in derived from profit sharing agreement between the shareholders and the investment. Okay, we take for simple example that the bank, the Takaful company, buy a building. Yeah, the building costs 100 million ringgit. So there's an asset now 100 million ringgit. So for 100 million ringgit asset, they lease rental to people to use the space in the building. So at the end of the day, they will calculate the normal calculation. They say they expect average market return 10%. So they will rent the building to anybody who want to rent down there. They will calculate at the end of the year, they should make 1 million because 10 million, because just now they bought the building is 100 million. So if they can make 10% profit for 10 million, that is the rate of return on the asset. The asset just now is the building lah. That 10% from the rental from the building, so that is the return on the asset. That's what I'm trying to say. From the return of the asset, then they distribute to the shareholders at the end of the year through the profit sharing mudarabah lah. As I said before, you buy the insurance, you have to sign two agreement. One is the wakalah, the agency agreement between you and the insurance, and then the other agreement you have to sign the agreement, the mudarabah, for them to invest the money, the premium that you got into the business. Equity investment risk. Equity investment risk relate to the risk character of investment from mudarabah and musyarakah profit. Okay, so they may have invest in one or two product. First, maybe under mudarabah investment, then maybe also under musyarakah profit loss sharing business model. What we think today, talking here, the equity investment risk is the business model that the insurance company will go into to spread their risk, or we call it they spread the risk into one basket. They cannot put under one product, so they will invest in four or five other product, musyarakah, mudarabah, or all other kind of product. That this product sharing have different kind of returns, so they need to balance up. If one fail, the other one make, the other product make, then they can still give you the profit or rate of the return to your money that you invest with the insurance company at the end of the year. Yeah? So, yeah, I did mention just now the risk exposure. They can use the murabahah product, they can use the BI muajal, yeah. So all this thing is the detail lah, as I mentioned just now. If on equity, they go on mudarabah, leasing, you know lah, ijarah is a leasing. So if they buy ni aeroplane, they buy one aeroplane and lease it to Malaysia Airline system. They say lah, Takaful Malaysia buy aeroplane 300 million. They lease it to Malaysia Airline system because Malaysia system not enough aeroplane, so they need to have another one aeroplane but don't have the money. But Takaful got plenty of money, so they go and buy the aeroplane and lease it to the Malaysia Airline system. So they call it ijarah lah. They lease the system. Then sure lah, there's a market risk in case like now coronavirus. Even the Malaysia Airline maybe cannot pay the lease to Takaful because there's no flight. So these are market risk, credit risk. Whether the bank, the Malaysia Airline can pay or not, is they call it the credit risk lah. Market risk is now because of coronavirus. There's no people want to travel, so the risk is there lah. So these are all very interesting, but need more detail for you to understand lah. But roughly, I show you the example just now. In future, when you take maybe bachelor in Islamic finance, then you learn more, then you will be more interesting. Because you like and not also insurance, the Islamic finance is picking up. So future market for Islamic finance, as I always say, will be much more excitement, and we can see the growth earlier on from our earlier chapter, around 20% per year, the growth of Islamic finance activity all over the world. Yeah? So for you interested in this subject, it's good. In future, you want to take banking, Islamic banking should be your choice lah. Since commercial bank is already, well, I can say saturated or like that. But for the Islamic banking, it's still green lah. I mean, just the initial stage now. They have not come to level of saturation at the moment, and long way to go because they coming up with new innovative product here and there, so they need more people to work in the bank. Here in Malaysia, we have the only bank in the world, the only university in the world which teach 100% Islamic finance. They call it INSEF, INCEIF. You just Google INSEF. It's a university and it belongs to the central bank. So their program is all Bachelor Islamic Finance, Master Islamic Finance, and PhD Islamic Finance. The only one in the world now, university focus on Islamic financing. And they have students all over the world now. I did study there for a while, but I didn't complete it. But it's very interesting because I don't have time to study that time. But they are very good. So if you want, after this diploma, you want to focus on Islamic finance, look for this INSEF, INCEIF, university. Belong to the central bank, the government lah, mungkin belong to the government. Okay, so in conclusion, so we are talking about as an economic unit, the nature of risk of exposure of the financial institution is the most important consideration in determining the soundness and the stability of financial industry. When you talk about soundness, that means the market must be stable lah. Bukan soundness, you gila, it's not mad. Sound means you're talking here, the business is stable lah. Yeah. Then new challenges to risk management arise due to different investment and trading model of IFIs, as well as the need to be Sharia compliant all material aspects. As I said just now, yeah, there's so much business model and product that they have to select properly, not only on the return side, but also whether they are Sharia compliant product or not. So this is very challenging. Third, being able to identify and distinguish types of risk in the first step to understanding risk behavior, which is specialized area not deal with in this chapter. So, as I said, the Islamic finance institution is not fully matured yet. Yeah, so they are coming much more product to offer to the public compared to the conventional. Is almost like they are matured, they're quite stabilized, they're not new product that they are producing. But whereas the Islamic financial, they are growing because they are new, so they're coming up with all new kinds of product to offer to the public, to offer to the business people. Yeah? Scenario analysis of risk relationship between the shareholders were also introduced to explain the implication of equity, investment risk, rate of return risk, displaced commercial risk. We're talking about market risk lah, and on their expectation. So we already give you just now all the risk. I did go quite detailed on the risk just now, but still you can go deeper. So as this is the final chapter of this module, you should have acquired a reasonable understanding of the risk implication of financial activities on both the shareholders and the financial institution. Yeah. So the shareholders is you lah. You are the policy holder. You the one to buy the insurance, and the institution is the operator lah, the takaful operator. These are the financial institution. So we'll get Cheryl to go through for you this subject, final chapter. So there's time left. I already asked her to recap back from chapter 1 until today for the last 9 chapters, so that you can refresh your mind. If you in the past did not understanding certain point, you can go through back one by one through each of the chapter to make sure that you try to understand as much as possible. So important of teaching for you to learn, to understand. If we teach you don't learn anything, then it's wasting our time, wasting your time. Because there's always two parts of the situation. One is the teaching, we are the teaching. Second part, learning, you are the one who learn. So if we teach and you don't learn, we fail. So we must show that we teach, you learn, that we the success. And that is our mission in this college, to make sure every student learn from what we teach. It's not like a story telling, after that you forgot what the story. No, because this what you learn is going to affect in your life. You are the one to use it in the life in future. We may not even use it in future. So it's very important for you to learn and understand. Not very important for us to teach, because we are teaching, we are not going to use it in future. At my age, I don't use anymore in future, but you are the one going to pass through the journey, and you will come across all these things. So if you are well versed on this financing part, then you can make a choice whether you want to use the conventional, whether you want to use the Islamic. It's up to you. But then you know there's a chance for you to choose. The choice is yours. Yeah. But if you don't know about the Islamic finance, you just go to the conventional finance, then you may don't have the good deal, but there's a better deal here you have in Islamic finance. But you don't know, you don't approach them, you don't apply from them, you just go to the conventional bank. They're not going to tell you there's another good product in the Islamic bank. They are business people. You go to them, this is the thing they have. Even the one is not good as the Islamic finance, they're not going to tell you. That's where the knowledge is you have to learn. Yeah? You don't expect after this somebody on the street going to teach you anything more about this Islamic finance. It's you you're going to learn. After you understand, you can learn more. You can check from the Google. You can read here and there to understand more on the Islamic finance for your own benefit, for your family benefit, or whatever, for your business benefit. So until then, I finish up all my lectures on this Islamic finance and banking. Yeah? I really hope that you enjoy the subject, because this subject is more to your benefit actually. Your what you understand is going to benefit you in future. If you don't understand, you are going to lose in future, because there is an option, better option. You don't know, you didn't take it. Yeah. So I really hope that you can understand the concept of this Islamic finance and the implementation and the benefits and the differences within the conventional, so that you can make a smart choice to your whatever your decision in your financial requirement in the future. Thank you very much. All the best to all of you. Assalamualaikum warahmatullahi wabarakatuh.